Well, listen, we'll get started here on this beautiful sunny afternoon here in Vancouver. It is pretty terrible out there as I look out the window. Um, we'll spend together today probably about half an hour, 40 minutes is my intention. A little bit longer than the previous two, but lots of great slides. Good day of economic data that's been released today. Bank of Canada and the US Fed have come out and announced their rate policies for the balance of the year. For those of you that have missed it, Bank of Canada has held their rates. The US Fed has cut 25 basis points for the third time in a row. So we'll chat a little bit about that. Some of the slides that I have in here may overlap what's actually been announced today because I put this together over the last couple of days. As usual, what I'm going to suggest is if you have questions or comments throughout the session, please add it to the Q&A, which can generally be found at the bottom of your screen. Just click on it, type in whatever it is. I'll try and answer your questions along the way. If not, we'll open up some time at the end for some of the questions. I've also received some questions leading up to this session, so I will try and make sure to address those before we wrap up. All right. Sorry, guys. This is a little delayed here. There we go. So on the agenda today, we're going to talk about what 2025 has taught us, and then we'll spend a couple of minutes on 2026. So as we noted, the markets have priced in the expectation of a rate cut kind of from mid-November onwards here. Today, what we're seeing with the US Fed cutting, Dow Jones has actually marched forward since the announcement. S&P 500 has fared somewhat okay. We're not seeing dramatic moves from the US Fed today, but we saw it over the last 2 weeks. So the US Fed, the rate cut has confirmed what we anticipated. Had we not had a rate cut, I feel we would have likely seen some red on the board today. So let's look at 2025. So 2025 has been the year of resilience. I think is probably the easiest way of saying that. Obviously, we headed into the year, we anticipated, at least I anticipated, a fairly decent year. I thought if we actually squeaked out, high single digit gains, low double digit gains, I would have been quite pleased. And the 2024, the end of 2024 set us up, I think, for that. We were going into 2025 with the expectation that corporate earnings would remain strong. We anticipated rates would actually come down over the year. But what we didn't anticipate was the trade policies out of the US, tariffs and so on, that we saw, as we came from February, March, April. And if you look at this orange line here, this is the downturn of the S&P 500. And these blue dots you see on the chart is the GDP growth that we saw. And so coming into or out of the first quarter of the year, we saw a fairly significant decline within the S&P 500, only to be subsequently kind of picking up throughout the latter half of the year, notwithstanding a couple periods of volatility that we've seen. And there's reasons why. Again, corporate earnings has been really strong in Q2 and Q3. We're starting to get some additional corporate earnings of big companies that are reporting over the next little bit. But generally speaking, things have been pretty positive. Rates obviously have come down here in the last quarter and a bit. So things are looking positive for the balance of the year with the US Fed's decision today. I would expect somewhat of a muted last few weeks of the year unless something comes out that surprises us. Policy rate cuts again, on the US side, I've said this before, but I thought it was relevant because, again, this is really what's been driving the markets more so than some of these other things that, were on our mind in the middle of the year. The US Fed stance has really been the one that, we've all been waiting on. So in Canada, which is the red line, we're at the bottom part of our rate cutting in general. We started cutting, Bank of Canada started cutting long before the US Fed, as we can see on that line. US Fed was one of the last central banks to actually start cutting. So when we look globally at central banks, most banks have been cutting, throughout the last 12 to 18 months. It wasn't until roughly 3 months ago that the US really started to cut again. And we still think there's actually more cuts to be had from the US as we lead into 2026. they're obviously a little bit cautious. They have some sticky inflation down there. We'll talk a little bit about the status of the economy right now, but generally speaking, things are still costly. Like I said, the economy is not in great footing down there. So again, labor markets are starting to shrink. So making money cheap to prop up the economy. And when I say prop up, I don't mean that in a negative way, but to make money cheaper, borrowing rates cheaper, rates for companies to reinvest, to borrow and reinvest into their businesses, again, for profitability and so on. And there's always positives with cheaper money across the board when you look from an economic point of view. I thought it was relevant that we looked at, the markets over the last, 4 to 8 years or so. And what we've seen with Trump 2.0 is we've seen a lot of volatility, a lot of uncertainty in the markets. And I think that was heightened when he came out and talked about, Canada being the 51st state. As a Canadian, very patriotic, I think it really shook a lot of us at our core, because it wasn't just about trade policies. It was about our very being of being, a Canadian. And what's interesting on this chart, if we actually go back to his first term, President Trump's presidency 1.0 versus 2.0, this is a chart of uncertainty. And what's really interesting is when we look at the first term, the uncertainty within his first term increased. And, during the Biden administration, when you see that uncertainty leveled out, it was much more predictable and calm. And since Trump's been in the second time, we can see this uncertainty index actually peak again. So this isn't new. Even these tariffs, in his first term, he had tariffs when they were going through the negotiation with the trade deal here in North America. So this is his policy. This is the way he manages government. This is the way he negotiates, which I'll talk about in one sec. But the challenge for us as investors is we're subject to a lot of this up and down volatility, which actually bothers us from an emotional point of view. Very tough to have confidence in the markets, the economic outlook, our portfolios, when we have a lot of uncertainty created by some of the leaders in the world. So I mentioned about Trump negotiation tactics. So again, what we've seen throughout this year is, obviously he anchors with extreme offers. He's not in the middle. He's very much out there. He's very abrasive. And he frames the outcomes in a very negative manner. And what he does is this to create urgency. This is the way he negotiates. And the challenge with this is because he creates uncertainty, is that it, again, from an investment point of view, managing, portfolio net worth and so on, it creates a lot more angst within just our day-to-day lives. Okay. And the challenge as well is he uses his True Social, his platform as leverage. So not only are we getting his comments when we see it in the media, but on the fly, he's making very unpresidential comments that actually influence the markets, influence investors, and so on. Okay. Now, when we look at trade agreements, let's break it down. Of the 200 that he had, he's only signed 13 of them. So 187 agreements are still remaining to be negotiated. So he actually hasn't made that much progress. Okay. He has secured substantial commitments to invest in the U.S. economy. The challenge is that could take years to come to fruition. And perhaps when we have the next term of the new president, some of these commitments may be rolled back. So as much as he's saying the U.S. is getting a lot of commitments globally, it's really not going to impact them significantly in the near term. And then the other problem is a lot of these countries are actually having, reduced, or they have retaliatory tariffs. So again, he's reduced retaliatory tariffs, but we just saw Canada actually announce additional tariffs a week to 2 weeks ago on U.S. goods. And now there's talk about the U.S. actually increasing tariffs on Canadian fertilizer. So again, it's somewhat problematic. It's not great for the economy. We're seeing in the bottom line with goods and services as it trickles down, which we'll talk about in a second. But again, things are just getting pricier for folks in both the U.S. and Canada. As a result of the trade policies by Trump, and again, I don't know if anybody saw him last night talking about the economy, but Trump loves to just say everything is great. He gave his economy an A+++, and I think there might have been 2 more pluses. But the reality is he stands up there and he basically communicates things that are not necessarily happening in a broader economic context. So a really good example, that this year, the U.S. lags the rest of the world in terms of return on U.S. equities, the largest since the great financial crisis, or coming out of 2009. And then part of this, again, is his policy. A lot of this, and I saw this earlier, a lot of this is self-made. A lot of the challenges that the U.S. economy is facing potentially is self-made. So it's not fundamentally driven, but they're in this place because of tariffs, trade policies, and so on. Now, what's interesting is when we look at this, this is investor sentiment. What's interesting, despite some of the headwinds that we're seeing in the US, the overall investor sentiment is fairly neutral. Okay. And so what we saw earlier this year, and I'll just go back here, this is when trade and tariffs were announced. We can see, the investor sentiment was very negative. But as things have smoothed out over this year, we can see it's actually improved to the point where it was almost touching back in 2023, 24, where investors were extremely positive. Since November, we've actually seen that actually temper a little bit. Okay, so what's interesting is investor psyche and so on is much more neutral than what we're seeing from the economic point of view. And yeah, so why are we seeing growth as we head into the final stretch of the year, despite all these headwinds, despite all these headlines? So when we look at it from the beginning of the year, the trend, this is the trend, okay? And as we move through the year, there were certain events that actually reduced the overall trend. So we saw tariffs, we saw immigration policy. This created a lot of uncertainty. There was a lot of negative headwinds in the first half of the year. And what's happened in Q2 and Q3, obviously financial conditions have improved corporately, corporate earnings. I think I said this in some of my previous sessions. In Q2, the average companies that either met or exceeded earnings or estimates was somewhere around, historically speaking, around 65%. In Q2, it was as high as 75 to 80%. Q3 brought us even better numbers. Over 80% of companies that reported exceeded or met expectations. So again, corporations are actually humming along, and it makes sense. Obviously, again, money's getting cheaper. A lot of things are coming back in home, but yeah, people are spending. So then we look again, fiscal policy is getting looser, which is again good, and the deregulation. So one of the things, they had this big bill that was announced in the U.S. One of the things under the Trump administration is there's less regulation. So mergers and acquisitions, as a good example, it's a lot easier for these companies that are buying each other to get through the hurdle of the compliance process to get done. And so what could take a long period of time under the Biden administration, under the Trump administration, is happening at a much quicker rate. So that bodes well for companies that are looking to acquire. It bodes well for arbitrage strategies. So again, things are looking up, and I think this is important as we head into the final stretch of the year and into 2026. Okay, so where did the returns come from? Okay, and we look at the S&P emerging markets global and the S&P 500. This is a great chart. Okay, so when we look at the S&P TSX, which has actually had a really good year this year, the triangle is the total return in Canadian dollars. Well, the red on this bar here, that's actually come from earnings reports. Okay, we've also seen some dividends that have contributed to it, and then the PE ratio. So really, it's fundamentally driven rather than event driven. And even when we look at emerging markets, and again globally, not so much on the European side, but most of that's driving the gains in the markets is strong fundamental earnings. Okay, on the U.S. side, again, a little bit more muted. And what's interesting is you can actually see in here the impact of the U.S. Canadian dollar on the overall returns. So for the first time in ages, S&P 500 has actually lagged a lot of its global counterparts. Now, I talked about this in the my previous session last month. We're seeing, you've heard of a V-shaped recovery when we talk about, from an economic point of view. We've also seen we've seen all these different types of economies. Well, one that's a newer one is called this K-shaped economy. Okay. And what this K-shaped economy is saying, what it's saying is there's a divergence between the upper class and the middle to low class, where individuals that have money, the wealthy that have money invested in the markets, and that's for a lot of folks that are on this call. And again, I wouldn't even just say the wealthy, but people that have access to dollars that's invested and are getting the ability to take advantage of these corporate earnings, these rising gains from, whether it's growth companies, dividend companies, or what have you. So the folks that actually are investing in the markets are getting wealthier. And the ones, unfortunately, that don't have the dollars to be investing, they're actually plateauing or actually going down because they're not able to actually benefit from the gains in the markets. And rather, their dollars are going towards more of the necessities, lifestyle, their general expenses, food and shelter, and so on. So what we're seeing on the bottom half of the economy is we're actually seeing people struggle more at it. And that's why they call it a K-shaped recovery. The wealthier are getting wealthier, the middle to lower are actually feeling the pinch even on a more frequent basis. And this is a little bit problematic, obviously. We obviously want to have the full economy, all asset classes doing well. The wider we get with this, the more problematic it is. And we're seeing it. I've used this example of a number of times. If you go to the grocery store, I think over the last 12 to 24 months, every time you walk out of the store, there's less items in your bag. And it's tough. So we're seeing a lot of individuals, a lot of families that are struggling. And again, this is the reason why, last year we put a lot of our dollars at Christmas towards helping families in need. We served 10,000 meals last year at Christmas, and I'm excited to share some news that'll come out over the next week or two about what we're doing this year in 2025 and the impact that we're looking to have with folks around the province. Again, it's an unfortunate state of what's happening in the general economic climate, but again, we have a lot of folks that are struggling because again, their basic necessities are getting a lot more expensive. And then another reason why 2025 has been more robust than I think a lot of people would have expected is we're starting to see a lot of the AI, the artificial intelligence investments, that people started or companies started to invest in over the last couple of years. We're starting to see it actually contribute to their earnings. So here's a really good example. All the ones on the left that are green have been positive. The ones that are gray is neutral, and there's one that's negative. From a point of view of the investments. But overall, in general, we're starting to see a lot of these large companies really benefit from what they did a year or 2, 3 years ago. And I mentioned this before, we're going through this innovative wave within the economy, within the markets, where we're seeing robotics and AI and just how businesses run their day-to-day businesses. It's affecting ours as well. AI-related data, AI-related technology is definitely used more on a day-to-day basis today than what it was 2, 3, 4, 5 years ago. Okay, so we're going to again see this as we continue to go through this cycle. Things will get more streamlined. Obviously, margins will likely improve because they're going to be able to get more efficient as companies. So more and more of this investment, this infrastructure is going to benefit these companies. And when you look at CapEx or capital expenditures from these big companies, they're significant. That these big companies, 8 to 10 largest companies in the world, which a lot of them are in the U.S., the companies like Google and Alphabet, which is sort of the same, Microsoft, NVIDIA, they are spending at a very quick rate to reinvest in this AI driven kind of technology. And it's no question it's going to happen at a quicker rate and it's going to drive significant amounts of growth in the next 5, 10, 15 years. And then last couple of slides on 2025, again, I've talked a lot about the impact of the Mag 7 or the top 8 companies or what have you. I got 2 last slides. Obviously, a lot of the growth that we've actually seen in the markets and the economy are coming from these businesses. Now, last session I talked about, the tech wreck of 2000, 2001, 2002. This is much different. A lot of these large companies, they have great balance sheets, good cash balances. Again, they have a lot of different types of businesses within their overall structure. And so unlike 2000 and 2001, where there was a lot of companies that didn't have a lot of profitability, some of the largest ones that are driving market growth, again, are very well funded, have lots of cash on hand, and are having significant impacts on how technology is evolving. So we're going to look at this one here just from a total return. when we actually look at the S&P 500 and we actually take out those 7 top companies over the last 4 or 5 years, we can see the significant difference in growth. Okay. When you take out those top 7 companies, we actually trail kind of world growth when you actually remove the US companies. And when we look here, this is actually really interesting. When you look at global markets, the US represents roughly 60% of global markets. Again, Canada is less than 3%. And this is one of the things that we've stressed to our families about making sure we're diversified, because unfortunately, Canada represents a very small piece of the global market. It's a very narrow market, but we should still be owning it. But what's interesting when you actually look at the global markets in general, the Magnificent Seven, they would be considered the 3rd largest market based on market cap in the world. Okay, which is significant. So again, these are a lot of these companies are based in the US, but they're globally, obviously they have global influence. I like to use an example of Coca-Cola, US company, but it's international. So these companies extend much further away from just the US. And this is one of the reasons I talked about early in the new year when we had trade related policies coming down the pike from the US. I wrote an article on it saying, despite our feelings about the US, here are reasons why we should continue to own these companies. And for our clients that have continued down that approach, you've all benefited from it this year. Okay. So with that, let's talk about 2026. And I'm just going to have a look here about, I'm just going to see. All right, I'll come back to that question. I'm sorry. I just got a good question. I'll come back to it in a second. So just looking ahead, 2026. So when we look at the overall economic kind of feeling about what 2026 is going to hold, if we actually look in a perfect world, they call it the Goldilocks kind of 5%. But what's interesting is, if you look at the trend of everybody that was analyzed, we have some folks that feel that we could have a recession, some folks that feel that we could do better than the average. Well, what's actually positive about this is there's more analysts and more people feeling that the market will be above trend than the likelihood of a recession. Okay. So generally speaking, when I look at 2026, I think my view is very similar to coming into 2025. If we could be in a position where we get good, strong single-digit growth, maybe low double-digit, I think that would be a good year out of the US. In Canada, it might be a little bit more muted. We've had an exceptional year this year. But as interest rates come down, investors have to look to place money, not in interest-bearing investments that are 100% taxable and now paying between 2.5% to 3%, but in other things that are actually tax preferred and actually have the ability to grow and also maybe pay between a 4% to 5% dividend, which is actually taxed at a better rate. So from an optimistic point of view, again, going into 2026, generally speaking, the vibe is positive. Okay. Now, when we look at GDP growth in Canada, and this actually looks at this year and going forward, the forecast for GDP growth in Canada is positive. Okay. So we see 2025, 2026 are a little bit more muted, but in the 2027, 8, 9, it actually picks up steam. Okay. So we've actually had a fairly resilient economy, a fairly resilient GDP forecast. So we actually anticipate Canada to continue to strengthen as we head into the years next year and beyond. Now, again, what comes out of obviously US policies is there a way that we can quote unquote Trump-proof the economy? So one of the things out of the budget, and again, is at the top, Canada's looking to double non-US exports over the next decade. They obviously want to have more diversification with trade. All right. And they're investing. You've seen some of these announcements in port and rail infrastructure. They also want to have Arctic infrastructure. So they're spending money in infrastructure. And for folks that own, obviously our real estate and infrastructure pool, this benefits our clients because, again, a lot of dollars are flowing into these infrastructure projects. So again, when we look at these opportunities, I talk about Europe and then again, the Indo-Pacific region. Again, if you actually look at what we were in 2024, at the bottom there, 65 billion of exports to these regions outside of the US. On Indo-Pacific is 72 billion. The goal is to double that over the next decade. Okay. Now that benefit obviously is we become less reliant on the US. We become more diversified and hopefully we secure kind of our economic outlook in a little bit better fashion than where we are today. Let's talk a little bit about flipping gears here on US CAD. So US CAD, we have people that are asking, what's going to happen on the Canadian dollar side. It's really difficult to predict. Obviously, we saw some changes earlier this year when there was a little bit of concern about the US dollar. I think it kind of fell out of favor with some of the global economies because of some of the risk that was brought on by some of Trump's policies. Well, right now it's trading at a little higher than I think what they anticipate. I think the Canadian dollar will likely strengthen a little bit, fall into that 132, 138 range. And that makes sense. When you go with infrastructure, you look at the impact it's having on energy. Then Canada obviously has a fairly big energy sector. Things like that will benefit us. So again, it makes sense that our Canadian dollar should likely appreciate here in the near term over the next couple of years. What is it going to do this week, next week, a month from now? I don't know. It's really difficult to predict because things can change quickly. But I think when we look at a cycle, we would anticipate the Canadian dollar to actually strengthen from where it is today. And then just in general, from an economic recovery, again, when we look at from a production point of view, what's actually interesting is when we actually look at this data, you can see kind of the 12-month leading PMI model and then where it is today. You can see they track very close. Okay, here's where we are today, the dark color. Right? The red is the forecast. So anything below 50 is a little bit more concerned. You can generally see when it's below 50 is in the recessionary periods. Okay? We haven't had a recessionary period, but in fact, they anticipate things to improve. So again, keep in mind when we talk about recessions are always backwards looking. The data comes in and they say, hey, we were in a recession 4 months ago, 3 months ago, or what have you. But from a forward-looking point of view, at least today, we think things are going to improve into that period of more growth, and we see contraction when it comes into this manufacturing data. And then I talked about this earlier, earnings growth, folks. What's in store for it? I think this is really important. We watch it closely. Despite the negativity that we've actually had throughout the year, corporate earnings have actually been pretty resilient. Okay, so when we actually look again, U.S., Canada, and then again we have a global. We can see U.S. and Canada obviously have been consistent overall. We saw a little bit more growth in some of these areas in emerging markets and so on. But 2025, which we're just closing out, 2026, 2027, we still anticipate to have strong earnings and growth. Yes, we're going to probably get some surprises with some companies here and there. We did last quarter, we did the quarter before, but generally the outlook for the earnings on these companies globally, not just here in the US or here in Canada, is positive. We actually think the US will be one of the stronger economies from an earnings perspective. Again, that makes sense when you look at the companies that are driving the boat down there. We're going to likely to continue to see these economic drivers across the board. So from an equity point of view, okay, if we actually look at this chart, this is when you see the green bar here, or you see that, I don't know, you might see beige or gray, maybe a different color. When it's green, it means it's generally positive. When it's this beige brown color, it's usually negative. Well, what we're in right now is we're in this green zone. It's more favorable for equities in general, and that's what we've seen. So again, we're not suggesting that we go all in on equities. We need to be cautiously optimistic, but we don't feel we need to be more conservative, despite a lot of the noise that's out there. It's important to sift through it. But generally, on the whole, from an economic outlook, market outlook, corporate point of view, it's looking more optimistic than negative. Okay, now some things changed. There's no question. And that's why we need to stay on top and properly, manage your wealth, manage the portfolios, make sure we're well diversified. By no means are we in this robust period of high flying gains, but we do believe there will be continued gains, obviously with some ups and downs, but generally speaking, in a cycle, we'll have more ups than we'll have more downs. Okay. So we believe it is green lights for equity. I think part of where people, they get trapped a little bit is we're seeing negative news. We feel it's been a long year, again, given back to what I said about Trump and how uncertain, how volatile it is from an uncertainty point of view, both in his first term and his second term. unfortunately for investors, it gets a little bit tiresome. We get a little bit worn out, and we're a little bit more open-minded to negative news that comes out in the markets. But generally speaking, we believe owning good quality companies, both now and into 2026 and beyond, is the right way to manage people's net worth. Okay. And this is my last slide. So this is just gives you an idea. And again, I use the S&P 500 as a benchmark. But currently, notwithstanding what's happened today, currently as of December 28th, or December 8th, I'm sorry, the S&P 500 was trading around 6,800. That was the level it was at. So when we look at companies like Barclays, Bank of America, RBC, Morgan Stanley, Wells Fargo, so their targets in 2026 as of December 8th is all higher, right? Bank of America is a little bit more conservative. They're saying it could be 3 to 4%, but we're also seeing on the high side, Morgan Stanley, Wells Fargo, and so on, could be another double-digit gain. And I did this last year. If I go back to my session in December last year, we did something very similar. So given the outlook, we anticipate markets to have modest growth again next year. And if we continue to get, a softening of the US Fed, rates coming down, that's going to continue to be beneficial for markets, to be beneficial for companies, and beneficial for the consumers, because money gets cheaper, which means they have more dollars to spend in the economy. All these things are going to benefit the markets. Okay. And so with that, that's my last slide. I'm going to go back. I have a couple questions on the side here. Like I said, I can't believe we've been doing these now, I think, for 9 straight months. We used to do these quarterly. This is the last of the year. The January one, obviously, we're going to start talking about what do we need to be considering here in the first quarter of the year. But it's been a wild ride this year, to say the least. But I'm really proud that our families have really stuck to it. They've maintained their consistency and their discipline. And as a result, they were rewarded this year. And we've actually had a pretty good couple of years, which is fantastic. These good years obviously soften some of the negative years that we know are going to come in the future. Folks, markets are cyclical. And so rather than trying to predict what's going to happen tomorrow or 6 months from now, we just accept that, hey, things are going to go through periods and we need to tweak the investments. But at the end of the day, we need your money to grow and keep up with tax and inflation and have additional growth above and beyond that. That is the goal. That is why we invest, me included. It's not for fun, but rather we need to keep up with tax and inflation, because it goes back to what I said right in the very beginning. Our cost of goods and services are going up, and they'll continue to go up for the foreseeable future. So if our money is not growing or keeping up with it, even though it might feel like the right thing to do to have it just stuck in a bank or under a mattress, the problem is, even though your money doesn't fluctuate, it actually goes down in value, because you cannot buy as much goods and services in 2, 3, 4, 5 years as what you can today. So it needs to grow for you. So again, I'm proud of what we've been able to do. I'm proud of our clients and families. And like I said, going into 2026, I would anticipate, again, cautious optimism. But as things stand today, we think it's going to be another decent year. So, okay, I've got a lot of questions here. So let me see. I see somebody here. Lots of talk about IT stocks and the system itself. IT is not a tangible product. Let's see here. So I don't know. So what they're saying is, from an IT point of view, are these companies producing something that's tangible? The answer to that is absolutely. Again, I just think about where we were. It'd be like saying 20 years ago, when we didn't have the internet or we didn't have the web services as successful as what we are today. Those weren't tangible either. But think about how that influences our life today. Okay. I don't know many people that don't have a phone, that don't have a data plan, that aren't using the internet or some form of data on a daily basis. So, when you look at AI as an example, and it's proven, there's studies out there. AI isn't just artificial intelligence. I had somebody say they actually more so look at it as amplified or accelerated intelligence. So things that took years to compute and essentially have growth now happens in a very short period of time. So what happens is we can actually go through cycles at a much quicker period. And AI is being used on so many different forms. Just I use AI as a very general topic, but it's just on day-to-day business nowadays. And for big businesses, it also creates efficiencies and more profitability, which actually goes down to GDP growth and so on and so forth. So absolutely, they are creating a product. They are creating something that's tangible. It's not the same as owning a gold bar or silver, but it's definitely applicable in our day-to-day lives. So, I had somebody else that just said, "Hey, nice job with the consistency and quality of the information that's provided." Thank you. I appreciate that. Guys, one of the things I ask, and I reach out, if anybody here has ideas for future topics, presentations, what have you, we are always open-minded to getting the feedback. And that can be done as easy as an email, or when you're chatting with somebody in our team, just let them know. We obviously want to design these sessions that are helpful. I think they are helpful because, again, we go through a little bit of an economic outlook at the time when we're on. But if there is anything, as an example, we did an estate session about, I don't know, 3 months ago, where we brought in a guest speaker. It was really well attended and people found it super helpful. So we can do, again, more of these collaborations with other professionals. Maybe in tax season, we bring in an accountant. I'm not sure. But we try and make it broad so that so for most of you that attend, there is something that is relevant to your financial situation, or perhaps even just when you have questions about the general economy outlook or so on, we can provide a little bit of peace of mind and context about what we're thinking about. Because I know for me personally, I have money invested in the market as well. So I'm looking at all this too. Okay. I got one other question. Let's see. Yeah, actually, we're pretty much done, actually. There was one that somebody had asked about a prediction for 2026, which I had talked about. And then I guess my last piece is not really economic or really market related, but for a lot of you on this call, I just want to wish everybody obviously happy holidays. We're 2.5 weeks away from Christmas, which I don't know where time flies. But I just want to wish everybody all the best for their families. I hope everybody has a wonderful time, and obviously into the new year, another happy, healthy, and prosperous 2026. As I mentioned with all of our sessions, when we wrap up, if there's anything that you have questions on, or you want to reach out, touch base, we're happy to connect on a call or what have you, provide any additional thoughts. So with that, folks, enjoy the rest of the day. It's a dark one here in Vancouver. Hopefully, we'll get some nice weather between now and Christmas. But in any case, it's been an absolute pleasure to share our ideas with everybody. We look forward to 2026 and another successful year ahead. Guys, take care. We'll talk to you soon. Take care.